broader picture now. What's the outlook for 2017 from a global perspective? Marc Faber, the editor and publisher of the Gloom, Boom and Doom report, joins us now. Marc, good afternoon. Happy New Year to you. It's great speaking to you at the start of a new year.
Happy New Year.
Thank you. We have big events lined up in India this month. I mean, there's earnings, there's the budget, and of course, we're still reeling under the aftermath of the demonetization impact, something that you spoke about earlier where you said that you don't support it. What's your view on India now for at least the next 6 months?
Well, I think the market became oversold a week ago, and we can rebound somewhat here. I don't think that the global markets will go up strongly. We had actually last year some very strong rebounds in Russia, up 56% in dollar terms, Brazil up 66% in dollar terms, and then we had in Asia many markets that were up between 15 and 30%. I don't think this will be repeated next year, but obviously we have this huge liquidity in the world, and whenever somebody will sell something, he will buy something else. In other words, if people sell the US dollars, if people sell the US stock market, they can reinvest the proceeds somewhere else.
Okay. Marc, hi, good afternoon. So, in emerging markets, where would India rank right now? Because 2016 was one of the few years where Indian market actually underperformed the emerging market universe by quite a margin.
Yes, it's not the first time that India has underperformed. But I think the outlook longer term, and I'm a long-term investor, I look ahead at 5-10 years, I think that there are great opportunities. But I'd like to point out one thing about the markets. In the last few years, there has been a trend to indexation. In other words, you just buy the index in a market, and you hope that the index will go up, and the institutions buy the indices because the costs are low associated with ETFs that follow an index. Whereas active management, the fees are higher, and in the last few years, the active managers have by and large underperformed the market. But I think this is going to change. If I look at last year, some sectors, and as I just pointed out, some markets have performed very well. And I think in India, it's a case of not necessarily owning the index, but owning individual sectors, as was the case in other markets last year. In the US, energy was the best performing sector, and other sectors didn't perform very well, say the high flyers, the Netflix, Facebook, Amazon, and so forth. In the second half of the year, they underperformed or even went down. So I believe it's more a question rather than to worry about where will the market go, but the question is what sectors will do best. And before, you had someone on your station that talked about agriculture and food stocks. I think this is a sector that is actually attractive because agricultural commodity prices are depressed. They've been going down since 2011, 2012. And started to move up last year with, say, sugar almost doubling. So I think that there is a play in agricultural companies, plantations.
Okay, that's interesting. I mean, it comes at a right time because today in our own markets, we have a lot of sugar stocks rising, rice stocks are doing very well. So I guess your point is well taken. But, to slightly come back to the bigger picture then, what is, according to you, the biggest risk for global markets in 2017?
The biggest risk, in my view, are geopolitical events. I think it would be really a bad idea for the US to pick a trade war with China. I think that China has much more endurance in terms of enduring hardship than the US. And I think that the US consumer would suffer more from a trade war than China. The US only accounts for 18% of Chinese exports. And in the case of steel, the imports into the US from China are only 3%. So you can see that actually China doesn't depend on steel exports to the US for its well-being. And they could easily divert part of the exports that go to the US today to other countries. Now, the second risk, which is frequently overlooked, when Mr. Reagan became president in 1981, he was elected in November 1980, asset markets were very depressed and interest rates at a very elevated level. The treasury yield in America on the 20 years, 30-year bonds was over 15%. So he inherited a huge tailwind of diminishing inflation, falling interest rates, and depressed assets that had a huge upside potential in the 1980s. Trump, he inherits, and that's the biggest risk, hugely inflated asset markets. The bond markets in the developed countries, as you know, have the lowest yield they ever had in the history of mankind. The bond yields will not go much lower. Now, can the 10 years yield that has gone from 1.34% to 2.5%, can it go back to 1.7% or 1.5%? Yes, possible. It won't go much below zero. And number two, when you look at stock markets as a percent of the economy, the stock markets around the world as a percent of the economy are at a very high level, especially in the US. In other countries, less so, but in the US, they are. Furthermore, the US stock market has significantly, and I repeat, significantly outperformed other markets in the world since 2011, and it leaves it vulnerable to an adjustment. The adjustment may happen with the US not going up a lot, but other markets like India, emerging markets in general, Europe outperforming the US, or it could happen with everything coming down and then the US underperforming, going down more than other markets, which actually would be my view what will happen.